Here we're going to be covering very basic financial jargon that you should know, and if you're just starting out in your journey of financial literacy I'm on a journey and I just want to be really rich. If you're just starting out, you really need to know these terms because they're thrown around, and you want to know what they're talking about when they're using these words. So here's some jargon that, the finance bros, the old white people on news channels, and really they're basic. I'm rambling here, but we'll see how it goes. Assets and liabilities. Assets are items of value that an individual or company owns, such as cash, property, stocks, or your car. For instance, your home or savings accounts, they're all assets. In contrast, liabilities are debts or obligations, such as loans or credit cards. So if you owe $100,000 on a mortgage, that's a liability. They're very basic accounting terms, so assets is what you have and liabilities are what you owe. Net worth is a measure of financial health. It calculates as assets minus liabilities. For example, if you have $150,000 in assets and $50,000 in liabilities, your net worth is $100,000. Tracking your net worth helps you understand overall basic financial progression. Interest rates. An interest rate is the cost of borrowing money, expressed as a percentage point usually. For example, if you borrow $1,000 at 5% annual interest rate, annual meaning every year, you owe $50 every year because 5% of $1,000 is $50. Wait, what? 5% of $1,000 is $50. I am not good at math. Interest rates impact everything from mortgages to credit cards, and if you're taking out debt, you really want to know what the interest rate is. Compound interest. Compound interest is the favorite word to many investors. It means that interest is calculated both on the initial principal and the previously earned interest. So the initial amount and the amount of the previous interest that you get. So if you invest $1,000 at 5% every year, after 1 year you have $1,050. But in the second year, your interest of 5% isn't calculated based off of the $1,000, it's calculated based off the $1,050. And this compounds over time. It's a wonderful concept, and it helps you build wealth very, very sustainably over time. Equity. Equity represents ownership in basic terms. For example, if you own 100 shares in a company, you have equity in it. In real estate, home equity is the difference between the market value of your home and your mortgage value. You take out a mortgage, which is a big piece of debt, and the market value is how much you can sell your house for. So that difference between how much you already paid off and how much you could sell it for is sort of how much equity you have left in your home. Dividend. Dividend is a portion of a company's earnings distributed to shareholders. For example, if a company pays $1 in dividend per share and you own 100 shares, you'll receive $100 in dividends. It's a way that some companies make certain stocks attractive to investors because not all stocks offer dividends, and it can be a source of passive income. There's a debate between, whether you want sort of stocks that give dividends versus, stocks that are just going to go up in value. But it can be tax advantageous for dividends, and, it's kind of cool. Capital gains. Capital gains are profits from selling an asset for more than it's purchased. For instance, if you buy a stock at $50 and sell it at $70, you earn a capital gain of $20 per share. Conversely, selling for less would result in a capital loss. This is very important for your taxes. Bear market and bull market. A bear market is when stock prices fall by 20% or more, indicating pessimism. People often use the analogy of a bear swiping down. And a bull market is when prices are rising, reflecting optimism. So the bull horns are going up. For instance, the 2008 financial crisis triggered a bear market. Prices went down swiftly, whereas a period of, say, between 2010 and 2020 largely saw a bull market going up, where everybody thought they were genius traders, but the market was just very, very good for everybody. Liquidity. Liquidity refers to how quickly an asset can be converted into cash. Cash is the most liquid asset, while real estate is less liquid since selling a property can take time. High liquidity assets are generally more flexible for immediate needs. So you can have a lot of different assets, your car, but you can't pay your bills with the car. You have to sell it first. You have to liquidate it first. Diversification. Diversification is an investment strategy to reduce the risk by spreading investments across different assets. For example, a portfolio with stocks, bonds, and real estate is diversified. Bonds are sort of these securities instruments, or kind of like stocks, except they're pieces of loans that you give to a company rather than pieces of the company itself. Real estate obviously is not a piece of a company, but it's a piece of land. Because you have different pieces of investments in your portfolio, if a stock drops significantly, then you can still rely on, say, the real estate or the bonds. Again, this approach helps protect against significant losses from any single asset. So that's why diversification is so important. A portfolio. A portfolio is a collection of financial assets held by an individual or institutions. For example, a retirement portfolio might include stocks, bonds, and mutual funds. Building a portfolio helps manage risks and achieve financial goals. Mutual funds, or exchange-traded funds, or ETFs. Mutual funds are pooled investments managed by professionals, while ETFs are similar, but they trade on an exchange like a stock. For example, an S&P 500 mutual fund pools investor money to buy a basket of stocks, while an S&P 500 ETF does buy the same but allows investors to buy or sell shares at any time. Often, ETFs are better because they are often ETFs can be advantageous because there's no one actively managing that fund, so there's little to no fees, whereas mutual funds, they have somebody managing it, so there are fees. But if you want to be completely hands-off, you probably do want somebody to manage it, and even if it means incurring fees, because let's say in a very down market, you'd probably want somebody to be a more active manager in that sort of pool of funds. But the general idea of ETFs and mutual funds is just, it's a basket of different companies, and you get a bit of a share of, say, the top 500 companies. You're going to get a bit of Google, a bit of Netflix, a bit of an oil company. And then it's a way to kind of diversify and have a portfolio in a very easy way. An index fund is a type of mutual fund or ETF that aims to replicate the performance of a specific market index, like the S&P 500. For example, an S&P 500 index fund holds stocks in the same proportion as the index, offering investors broad market exposure at low costs. It's a way to diversify without having to buy all these stocks individually and incurring transaction fees with each. That way you can just sort of buy this bundle. Inflation is the rate at which prices increase, reducing purchasing power. For example, if the inflation is at 3%, something that costs $100 today will cost $103 next year. Inflation impacts both spending and saving, often prompting people to invest to keep up with rising costs. Inflation is inevitable. That's why you just don't want your cash lying around doing nothing. Over the years, it'll lose value. You need it invested so it at least keeps up with inflation. ROI. ROI measures the profitability of an investment calculated as a percentage gain or loss relative to the investment cost. So if you buy a stock for $100 and sell it for $120, your return on investment is 20%. It's a quick way to evaluate an investment's success. Risk tolerance. Risk tolerance is your comfort level with the potential loss of investment value. Often younger investors with high risk tolerances might invest more in stocks, while those preferring retirement may prefer bonds, which are generally safer. Risk tolerance is just how much risk are you willing to stomach and take on, and that profile informs how you go about a recession. A recession is a period of economic decline, often defined by 2 consecutive quarters of negative GDP growth. The COVID-19 pandemic triggered a recession in early 2020 as businesses shut down and unemployment soared. Arguably, there's going to be a recession soon, or we're in one now. Bond. A bond is a fixed income security representing a loan from an investor to a borrower. For instance, a government bond might pay 3% annually over 10 years, providing steady income for bondholders. This means you're lending money out and they're paying you a fixed amount over a fixed amount of time. Unlike stocks, they don't go up and down. You just get a steady cash flow, so it's very safe. But it can be more risky depending on who you get the bond from. Remember, you're lending out money. If the company that you're lending out money could, go insolvent or get bankrupt, they're not going to pay you back most often than not. So sometimes bonds are more risky depending on who the bond is from, and often a higher interest rate is given to compensate you for that risk. Obviously, government bonds are the most safe and risk-free because the government's really not going to default on their bond. PE ratio, or the price to earning ratio. The PE ratio helps assess whether a company's stock is fairly valued by comparing its price to earnings per share. For instance, a stock priced at $50 with $5 earnings per share has a PE of 10, potentially indicating a good buy if it's below market average. Blue chip stocks represent large, reputable companies with reliable performance. For example, companies like Apple, Coca-Cola, Johnson & Johnson's are considered blue chip stocks. These stocks are often favored by conservative investors for their